Good morning from London. I'm Kriti Gupta alongside Johnson and Valerie Tytel. We're an hour away from the opening trade. Here's what you need to know. Vladimir Putin and Donald Trump due to meet in Alaska today in a historic summit to discuss the war in Ukraine, economic cooperation, and a new arms control treaty. Meanwhile, China's economy slowed across the board in July with factory activity, investment, and retail sales disappointing, suggesting tariffs are casting a shadow over the world's second largest economy. Meanwhile, stateside factories feeling the pressure, hot producer prices pushing traders to dial back expectations for a cut next month, with investors focused on margin pressure. Val.
An hour to go before the first cash equity trade here in Europe. We are seeing equity markets in the green. Euro Stoxx 50 futures up 0.5%, continuing their outperformance this week. We're up nearly 2% on the broad European equity market here. S&P 500 futures also in the green. Euro dollar at 116.70. The dollar was stronger yesterday, so no doubt we're giving back some of those gains. U.S. 10-year yield, we are down a basis point at 427, but it has been quite a round trip in fixed income. We're basically right where we started on Monday morning. The countdown to the opening trade starts right now.
We have a meeting with President Putin tomorrow. I think it's going to be a good meeting, but the more important meeting will be the second meeting that we're having. We're going to have a meeting with President Putin, President Zelensky, myself, and maybe we'll bring some of the European leaders along, maybe not.
President Trump downgrading expectations for this meeting. There's another meeting that's coming that's more important. Let's focus our attention on that one, maybe. What do you do with today? I don't know. You've got to get through retail sales before you get to what is happening in Alaska a little bit later on. That may be actually the market-moving event of the day. Kriti, the Alaska story, the summit we've all been waiting for, comes after market hours. So do we price this for Monday? How do we think about this from a market point of view?
Do you position this positively? Any sort of incremental positiveness, whether it's a second meeting, whether it's even positive commentary coming out of it, even a joint press conference, which we're expected to have as well, would in theory be viewed as positive, given that the expectations are so low from actually getting something concrete from this summit. That being said, I think we need to talk about how important this is. This is a historic summit. These two leaders haven't, or at least Vladimir Putin hasn't been on U.S. soil for 10 years. And the last time a U.S. leader has even spoken to Vladimir Putin was in June of 2021. That predates, of course, the war in Ukraine. The other piece of it is this is not just a Ukrainian story, it's economic cooperation, and it's a new arms control treaty. And this is a really big deal. These are the two nuclear powerhouses of the world that haven't actually had that nuclear control at all since the 80s.
I thought it was quite funny that Trump yesterday in that press conference you were just hearing said that there's a 25% chance the summit won't be successful. We've had many people around this table been trying to get a number of just how are they characterizing this meeting in terms of success or failure. Trump thinks there's a 25% chance of failure.
What is another meeting success?
I think the market would view a second meeting as a success, especially one that maybe involved a wider audience. He teased it yesterday, talking about European leaders, plural, making possibly
Who are those, by the way?
Exactly, Macron, von der Leyen, not really sure. But a second meeting that maybe involves Zelensky, I think that would definitely be seen as a positive. That the narrative between these two leaders is still continuing. Obviously, the negative would be that we don't get any joint press conference because the meeting has totally fallen apart. Zelensky doesn't get a phone call from President Trump. That would be a huge negative.
He says he's just going home. If it doesn't work, I'm just going home. I'm not going to talk to anybody. I'm just going home. I'm not going to brief. I'm not going to talk to European leaders. I'm just going to go home. That was Trump's line yesterday coming out of the press conference. But remember, we're just talking about a ceasefire here. This is stasis potentially, and that's not necessarily that good an outcome.
One step at a time.
I know, but a ceasefire is by definition temporary. And you could argue that the fear coming out of this summit will be that ultimately this just gives Putin time to reload the gun and get ready for the next conflict, that this is an ongoing overhang for markets, for the global economy, for the world, and that is just something that's going to be maybe you could argue set more in stone as a result of this summit. So I think defining a win here is really I think is difficult to do. It's also a complete wildcard event, to my mind. Let's talk about something that isn't a wildcard event, and that is what is happening with the Chinese data right now, which looks really disappointing. So industrial data slowing more than anticipated. Consumption slowing more than anticipated. Investment is slowing more than anticipated. The loan data is the story for me, which tells you that actually the Chinese are not committed, or Chinese industry and households are not committed to investing into the future, which I think is a really bad sign. Is this tariffs? is this the first sign of tariff effects on the Chinese economy, or is this domestically driven? Are these domestically driven issues that are impacting the Chinese economy? I think it's hard to separate those out this morning.
It's hard to separate out what exactly is driving this, but you could definitely take away from this narrative that, you know, China is attempting to reorient its economy away from exports and more towards the consumer, and that's clearly not going
Exports
well.
It's strong.
Not going easy.
Exports were the bit that worked.
And what you brought up loan demand there, soft loan demand, it was actually the first contraction in outstanding loan demand since 2005. You add that to this streak of deflation prints. China's economy has been in a deflation track, the worst since the 1990s, and it's just not looking good for the underlying consumer that they're hoping could push economic strength, could reorient the economy away from exports.
Well, as part of the reallocation trade away from the United States, the big bull case for China was one that they could weather the storm of tariffs even better, which, again, we're seeing cracks of in this data set, but also the fact that so much of the kind of fiscal stimulus is being pumped into that economy. The fact that we're having a little bit of deja vu from the fact that kind of bringing back the idea of the property crisis where they were trying to kind of protect the economy, protect the consumer, and weren't really able to. That's kind of what this feels like to me, that ultimately the very bull case for China maybe isn't as bullish as we thought.
Another leg lower in the property crisis would certainly be a huge blow for this economy, and I think that's certainly something you've got to look at now as being a realistic prospect. What's happening in terms of the overcapacity story is another factor. They're trying to dial that down, and that maybe is starting to show up in this data as well. But I keep reading articles telling me that China is prepared for a trade war with the United States, not Deng Xiaoping, I was about to talk about Deng Xiaoping, but Xi Jinping has set this economy up for a trade war with the United States, almost kind of reversing what Deng Xiaoping did kind of when he came into power, which was kind of exposing the Chinese economy to the world. Xi Jinping has kind of reversed that. I don't know. The data this morning speaks to the idea that maybe they're not that ready, and they are going to have a hard time.
I do think this plays more into the U.S.'s hands in terms of who's got the power in these trade negotiations now that we're seeing the softening of the Chinese economy. But let's laser in on what's going on in the U.S. economy. We've gotten a lot of updates this week. The latest was PPI that came the hottest in 3 years. Now, the market kind of shrugged it off. The equity market still notched a small gain, still made it another record high for the S&P 500. We did see Fed bets being pared back, but net on the week, U.S. two-year yields are still lower than we were when we started. So we are still pricing in more Fed cuts for September than when we were pre-CPI. But with this PPI report, yes, it was hot, but I think the market takeaway from it is a bit nuanced. The components that we're after that feed into PCE did not come as hot as the broader index. And I think that gave some solace to these the Fed pricing.
Take a step back, though. The narrative of late, I read lots of notes on a daily basis, and there's been this building argument that tariffs aren't going to have an effect, that actually the US is going to get away with it, that the effect of tariffs is going to be minimal, and you can move on and not worry about this tariff narrative. Did that get slightly undermined by this data that is showing that tariffs are having an effect?
Well, look, you could definitely argue that what caused the hotness, I should say, in CPI and PPI was more related to services, not goods. So that does, obviously, that poses bigger questions.
That's a much
perhaps.
bigger.
But the tariff-induced inflation, the stuff that the market was really worried about, the thing that drove all the upgrades to year-end forecast for CPI, for PCE, is not coming to fruition yet.
That being said, that is very much a consumer-focused lens, which completely natural given the U.S. is a consumer-driven economy. But it does throw cold water on the margin compression story. The idea that you see a lot of these corporate earnings on both sides of the Atlantic be able to weather that storm, you're not seeing that anymore. And I think the cushion, the liquidity cushion that so many of these corporates have is insulating some of that margin pressure. But for how long? That's really a hangover from COVID, not necessarily being able to weather the storm of tariffs.
Let's see what happens with retail sales a little bit later on today. I think that's going to be fascinating. I also think that just claims, we had claims yesterday. They were okay.
Came in decent.
The labour market looks like it's in okay shape. So you've got a labour market's in okay shape. Inflation's ticking a little bit higher. Does that scream Coutts to you?
We'll have to wait to see with Jackson Hole to see what the man himself thinks.
Yeah, absolutely.
Less than a week to go, perhaps.
Cowboy hats at the ready. Let's go. That's the story for next week. What have we got coming up right now? Fahad Kamal, Coutts & Co. CIO, is going to be joining us shortly to talk about his thoughts on these markets. Richard Dealer, former MI6 chief, is going to be joining us to give us an inside track on what we should expect out of this summit in Alaska a little bit later on. Patrick Armstrong, Perumi Wealth, CIO, recently quite positive on equities, beginning to sort of maybe back off that that theme, and we'll get his take on that. Tristram Leach, Apollo Management Head of Investments of Credit in Europe, joining us a little bit later on. Lots to talk about there. Defence, what's happening with the AI trade. Lots to talk about when it comes to private credit.
Yeah, when it comes to data that we're having our eye on today at 1:30 p.m. UK time, we do have U.S. retail sales. Remember, this is a direct feeder into U.S. GDP. So for the month of July, that's maybe our first reading on how U.S. growth and the U.S. consumer is holding up. Later in the day at 3 p.m., we have U.S. consumer sentiment. Eyes will be on the inflation expectation readings on those components as well. And then later at 8 p.m. UK time, the Trump-Putin meeting in Anchorage begins.
Okay. What else do you need to know this morning? Bloomberg has learned that Goldman Sachs is offering clients a stake in Millenium Management for a minimum commitment of $1 million. Millenium, London-based, is seeking buyers for a 10 to 15% stake in the firm at roughly $14 billion in terms of the valuation. Sources say that the team has been scouring for potential investors, including high-net-worth clients and even people working at Millenium's main competitors. Shares of United Health surging post-market on news that Warren Buffett's Berkshire Hathaway has taken a $1.6 billion stake in the company. According to regulatory filings, Berkshire bought 5 million shares of the health insurer last quarter. The same filing shows Buffett sold his entire holdings in T-Mobile and trimmed again stakes in Apple and Bank of America. Bloomberg understands that the Trump administration is in talks with Intel for the U.S. government potentially to take a stake in the chipmaker. We live in a different world now. According to people familiar with the plan, a deal would help shore up Intel's planned factory hub in Ohio, which has been repeatedly delayed, I should say. The D's important there. The talks come just a week after President Trump called for the removal of Intel's CEO, accusing him of being, quote, highly conflicted because of concerns about his earlier ties to China. We live in a different world.
Can we just highlight how big of a deal this is? I mean, I feel like this idea of a government having a stake in a corporation, a publicly traded corporation, although I've seen plenty of that here in Europe, this doesn't exist in the States. The only one that exists is Amtrak, and it's not publicly traded.
And look, there has been a lot of interventions in private sector businesses from the Trump administration. You begin with U.S. Steel. You can also point fingers at the Departments of Defense investment in MP Materials. That's the rare earth producer in the U.S. And then you add on this NVIDIA and AMD, call it a revenue sharing agreement with their China revenue. So this is like, I guess we're beginning to see a better picture here of what the Trump administration is after. They want AI security. They want to be directly involved in America's tech future.
It's a security story, to your point. And this is something that we saw with U.S. Steel as well, that the U.S. government needs to shore up these local kind of companies because Intel has been under a lot of pressure because they don't rely and have been under a lot of pressure to pull back on their reliance on China, Taiwan, South Korea, et cetera. And now you need the government backstop.
Yeah, this is capitalism with American characteristics, as Greg Gibb put it in the Wall Street Journal. Thought that was a great way to frame what's going on at the moment.
But it is a different, we are in a different world now. And the integration of the desire by the American government to get involved in so many aspects, to control so many different parts of the U.S. economy. This is something that we haven't seen for quite some time. And you do wonder what the lasting effects of this is going to be, if this is something that sticks, if we are in a different world. American capitalism is going to be different as a result of this. Does it make it... the American capitalism has been an amazing machine for the last few decades. Does it change as a result of this?
Yeah, so perhaps this is a slightly different economic model. But remember, the last time that the U.S. took such a big stake in companies, that was after 2008. And they were investing in car companies that were struggling. This is very different. They're investing in companies that are doing very well.
Is Intel doing very well?
Well, OK, NVIDIA, AMD, I pointed that side of the argument.
That's the revenues. That's different. That's not taking stakes. This is taking stakes, direct stakes in a business.
I wouldn't phrase their investment in Intel as a bailout. So I wouldn't go that far, right?
No.
You know, this is, U.S. wanting a piece of wanting to be involved in America's own success on the tech front.
Are governments good at this kind of stuff?
I guess we'll have to see.
History doesn't suggest they are, but we'll wait and see. Well, you can argue that China has been good, but that's the parallel.
Well, that's where maybe the U.S. can learn a little something from Europe's experience on that front. Coming up on the program, defense stocks very much in focus with future of the Ukraine war weighing of key interest to the sector. Plus, we'll also keep an eye on oil with Russian exports possibly hanging in the balance. What does that do to the global supply Up next, though, we will go right back to the markets. What matters here? Is it the geopolitical risk? Is it the Fed bet? Is it the data we're getting out of China? We're going to dive into that conversation. You should join it. IB plus BBTV Go is the function on your terminal to pose a question to us or our guests. This is Bloomberg. "42 minutes away from the opening trade across Europe. Take a look at futures, green across the screen. Maybe everything's fine. Maybe everything is great. Maybe it is an August Friday, and perhaps that's how we should watch it. Val, walk us through some of the data, though, yesterday. How should we be thinking about it when it comes to the markets?
Yeah, it's been a round trip when it comes to fixed income, especially the price action that we've seen this week in the front end, in those two-year yields, the very policy-sensitive two-year yields. We had a decent rally post the broadly inline CPI, but some of that was reversed by the hot PPI print yesterday. But net on net, we are still pricing in more easing from the Fed after this week, even though we had that PPI show the hottest increase in producer prices in 3 years. So we're still lower by 5 basis points in the front end. Odds for that Fed cut are still holding around just above 90% in September. We did manage to eke out gains when it comes to the S&P 500, closing in the green yesterday, coming very close to being up 10% on the year. Some of this was helped by news about Intel, by that government stake in Intel that definitely boosted tech shares into the close. But there is still a lot of risk events before we close the books on this week. At 1:30 p.m. London time, we get U.S. retail sales. Now, remember, retail sales is a direct feeder into GDP, and this is data for July. So this is a good first hint on how third quarter GDP will be setting up for the U.S. economy. We also get import prices. This has attracted a lot of attention on just what kind of nuance we can pick out from this print on how import prices are reacting to tariffs. And then lastly, the UMISH consumer sentiment out at 3 p.m. today. Guy.
Val, thanks very much. Let's talk about all of this with our next guest, Fahad Kamal, Chief Investment Officer at Coutts. Good morning.
Good morning.
How are you feeling? How was the week?
It's been a good week. I mean, here we are, all-time highs. The S&P 500, 10% up on the year. Who would have thought that a few months ago?
Okay. Does it carry on? More to come?
I think so. Look, ultimately, lots of noise, as you said, lots of noise in the data, as we know, lots of unprecedented activity with government intervention. But ultimately, it's a story about earnings, and the earnings have been spectacular.
Earnings have been spectacular. So this has been a fundamentally driven equity rally, not a multiple expansion rally.
Look, there's going to be multiple expansion, especially considering where we have been, in April. There's been obviously multiple collapse and then a multiple contraction from that level. But ultimately, where we were expecting earnings to be a few months ago compared to what they've actually delivered, that's been the real story of why markets are at all-time highs right now.
A low bar really helping that conversation. Now, when do we start to see more notable margin pressure?
Well, as you noted before, clearly, the PPI print yesterday is possibly the canary in the coal mine. But margins are at very, very healthy levels right now. Okay, so there is room for some margin compression to occur and still have very solid earnings.
So how are corporate balance sheets able to withstand this? Where's that cash? Where's that liquidity coming from? Is this a hangover just from COVID-era stimulus?
I think corporate balance sheets are in pretty good health. I mean, if you look at the spreads on high-yield debt, if you look at the levels of the absolute levels of yield that you're getting in the corporate debt market, etc., there appears to be very, very little fear of any kind of balance sheet impairment or pressure in the corporate space. I don't expect any kind of serious balance sheet impairment to occur for the foreseeable future, and the signs of recession are also very distant.
You've noted in your notes that the dollar is overvalued. Can you take us through your thoughts on that? You still like the U.S. equity market, but you're not so hot when it comes to the U.S. dollar.
Yeah, look, it's a very simple story. Effectively, the dollar is overvalued on a purchasing power parity basis, right? And it has been so for a long time. It was very expensive coming into this year. It can be expensive for a long time. We know that valuation isn't some timing signal. But what has happened since the beginning of the year, due to the various narratives about U.S. exceptionalism, etc., and due to some foreign parties wanting to diversify their holdings, you have had that undervaluation story combined with momentum that's been driven quite strongly negative for the dollar. Both of those things combined, I think, carry on for some time because the dollar, even as we sit, still remains reasonably overvalued versus most majors.
In that mind, are you looking for outperformance perhaps in the euro? We've been talking a lot about the potential outcomes of this U.S.-Russia meeting happening today. One of them could possibly be European strength in equities or in its currency. Do you think that's a good way to play your dollar short?
Look, who knows what happens today, especially given the parties involved. I mean, anything is possible, a very bullish outcome or a very bearish outcome. What's much more important is to realize that the dollar remains fundamentally overvalued and momentum is against it.
How much? How much is the dollar?
Versus sterling, about 15%.
Okay.
Still?
Yeah.
Still?
It was about 30% undervalued coming into the year,
Okay.
so it's about half of that is
And
gone.
against the euro?
A little bit more than that, probably about 20-25%.
Wow. Okay, so we're heading kind of north of 120. We're going kind of back into those kinds of levels.
If you were to simply view the purchasing power parity fair value,
cool.
yes.
So let's relate that back to equities. Year to date, and I'm only talking year to date because this picture looks slightly different over a 3-month basis. You are still, if you're a euro investor, you are still underwater year to date if you've invested in US markets.
Correct.
That's going to get worse, presumably, by what you're saying. Is there any reason for Europeans, if the currency is going to weaken, to put money to work in the United States?
So once again, I mean, you know, that undervaluation is not a guarantee, right? Number one, the first most important question is, do you like the equity market in the U.S.? The answer to that is yes, because of the earnings story. The second question is, what do you want to do about your currency exposure? Do you want to hedge or not? And we would recommend that we want U.S. exposure, but we want it somewhat hedged.
Okay.
Does the recent move or the recent reporting that the Trump administration is taking a stake in Intel, and then you combine that with this revenue sharing with NVIDIA and AMD when it comes to their China revenue, does that make you more bullish or bearish the AI story?
Look, it's a very unprecedented arrangement. There's no question about that. The implications of that, remain to be seen. I do think that we have to wait and see how this goes. I think it makes perfect sense from the corporate perspective, because if you think about $8 billion a year or $8 billion a quarter was the write-off that they had for Chinese sales, and if you annualize that, $30 billion or so, now they're going to get 85% of that, right? So it makes perfect sense. But obviously, it opens up a precedent that may have negative implications. We'll have to wait and see. But it perfectly makes sense for why the corporates did it, and we're supportive of that.
Well, let's use the example that Valerie just put up with Intel and broaden it out. Under Joe Biden, when there were all those chip grants coming, chips ended up becoming the safest place you could invest in because of, I don't want to use this phrase too liberally, but kind of the backing of the U.S. government in terms of how they were getting that kind of money. Does that feed into the way we should be viewing some of these corporates that are getting the attention of the government in not only their equity price, but their credit as well?
So, look, obviously, if the U.S. government is a stakeholder, clearly the perception of your debt will change. So I totally see that. Second of all, look, as I said, this is an unprecedented time when it comes to U.S. government intervention in the corporate space. The precedents that are being set, we'll have to wait and see about how those play out. What I think is certainly advantageous, and especially the share price for Intel would suggest that, is that at least in the short run, it's a very powerful backer, probably quite helpful when it comes to land grants in Ohio to build factories, etc. There are probably some very short-term positives that are tangible. The longer-term intangibles about the precedents being set, etc., time will tell.
All right. Fahad Kamal, CIO over at Coutts. We thank you so much for joining us on this Friday morning. Coming up on the program, it's the march to the summit in Alaska between Vladimir Putin and Donald Trump. We'll speak to the former MI6 chief, Sir Richard Dearlove, ahead of that summit. Stick with us. This is Bloomberg. "30 minutes away from the start of the opening trade, futures painting a fairly positive picture. I'm not necessarily sure the narrative is positive, but again, light volume, light liquidity, that's what we're expecting in today's session. But Eurostoxx 50 futures are marching higher by about 0.6%.
Let's check on the fixed income open here in Europe. European bonds not doing very much at the open. Yields are just slightly lower, tracking treasuries. It has been a bit of a round trip for global fixed income this week, but those German 10-year bonds are basically opening up where we were on Monday.
Everybody's on tenterhooks. Everybody's waiting for the main event of the day. It comes late in the day because it's in Alaska, which is obviously many time zones away, certainly from here in Europe, us here in Europe. Europe. The Russian President, Vladimir Putin, seeking to strengthen his rapport with Donald Trump ahead of the summit that is taking place in Alaska today. The US President, meanwhile, yesterday downplaying expectations on today's talk, saying a follow-up involving Ukraine's leader will be far more important. Let's talk to Bloomberg's Stephanie Baker, author of Punishing Putin, Inside the Global Economic War to Bring Down Russia. Good morning.
Morning.
How is Vladimir Putin going to play this? What is the preparation for this? What does it look like in terms of his expectation going into this? He was trying to big up Trump yesterday. He was trying to big up their relationship. He's very good at the mind games. What are we looking at?
He's extraordinarily good at the mind games. He's really good at reading his brief. He's on top of the details, and you will know he will go into this meeting prepared. And I think there are question marks as to whether or not Trump will be equally prepared. Putin wants to get back into Trump's good graces and head off additional sanctions. His economy is slowing down. He does not need additional pressure in terms of tariffs on his biggest oil customers like China and India. And I think what he wants to do is get in the room one-on-one. Remember, this is going to be a tete-a-tete with no advisors, just the translators, and try to convince Trump that actually there's a lot more here at stake. He's going to try to broaden the talks to include issues like arms control negotiations, which have stalled, potential U.S.-Russia trade and business deals, like in the area of critical minerals. And then he'll get to Ukraine. And, you know, the danger, of course, is that Trump may end up saying, talking about territory and emerge, talking about echoing Putin's line and talking about the need for land swaps, which is exactly what Ukraine does not want.
Stephanie, there's clearly a lot of risk, a lot of danger going into this summit. What's the best case scenario out of this?
Best case scenario is Trump says that Putin has agreed to an immediate and unconditional ceasefire. Now, that's going to be really tough because, as you know, you don't just say ceasefire and that's it. It's really complicated. You know, who monitors the ceasefire? You know, are there troops allowed to be supplied? All these, technical questions. But I think that would be a win for Trump and for Ukraine on the current lines of control. In other words, they're not talking about giving Russia any territory that it hasn't already gained on the ground. And I think a win would also mean no concessions to Russia, no sanctions relief. And we know that Putin is going into this wanting sanctions relief, in particular wanting sanctions relief for its aviation sector, which is really hurting because they have not been able to service all these Western planes, and they've had rising number of accidents. And I think, those are the main things that he wants. Putin wants some kind of sanctions relief, and if Trump can resist that, I think that would be a success.
Stephanie, we heard from Trump yesterday that he wants to set the table for the second meeting. If perhaps they announce a date of the second meeting and somehow, I guess, allude to the fact that maybe Zelensky would be there, do you think that would be a win on face value?
Well, Putin has resisted sitting down with Zelensky, saying certain conditions need to be met, and presumably those conditions are an agreement on his maximalist goals, which is things like Ukraine must commit to being neutral, not join NATO, caps on its military. And this has really been an attempt by Putin to play for time. So if they are able to arrange another meeting quickly, as Trump says he wants to do, that potentially could be a success, assuming Trump doesn't, concede too much ground to Putin in their one-on-one meeting today. Sorry.
I mean, it feels like a long way out, except it's so short. Bloomberg's Stephanie Baker walking us through the dynamics and what we can expect from that U.S.-Russia summit in Anchorage, Alaska. Let's get a little bit more analysis. I'm pleased to say Richard Dearlove, who is the head of the British Secret Intelligence Service, MI6, from 1999 until 2004, joins us this morning. Sir Richard, thank you so much for your time. As Stephanie was just laying out there are a lot of risks, a lot of dangers. In your view, what is the best case scenario and the odds coming out of this summit?
The best case scenario is some sort of retreat by Putin from his original objectives in invading Ukraine. I mean, we've seen absolutely no evidence that Putin is compromising his position. So we would like to see some indication that he's prepared to make concessions. And at the moment, there's no indication whatsoever.
Sir Richard, there's been a big question here, and Donald Trump has said this himself, that if there isn't some sort of ceasefire agreement that comes out of this, secondary sanctions, or as he uses the words tariff interchangeably, are imminent within days, perhaps. Walk us through the kind of pressure if secondary sanctions are ultimately put on some of Russia's biggest oil customers. I'm thinking of India, and I'm thinking of China.
Well, we've already seen them imposed on India, but they'll take time to work. And the effect really is on the Russian budget, the defense budget, and the fact that its energy sold cheaply to India and China in particular, which can sustain this huge expenditure on the war that Putin is obliged to make. But at the moment, this is a sort of slow burn issue. It will take a long time, in my view, to see any sort of strategic change. And the shorter term is more important, in my view, and that is also about military coercion. I mean, that Putin could have the pressure upped on him if America continues to supply significant weapons which will affect the battlefield, which they could easily do. Okay, we know that the purchase of these is probably going to have to be done through European allies, and the money not coming from the United States. And I think the only thing that Putin ultimately reacts to is a combination of military and economic coercion.
Given that, good morning, it's Guy. You put Vladimir Putin and Donald Trump in a room with nobody else other than translators. Who do you think comes out on top?
Well, maybe in terms of the optics, Putin might come out on top. But, you know, we've seen Trump sort of adjusting his position on Ukraine. I mean, if you look back to the NATO summit, after that summit, I think we all felt more confident that Trump was prepared to take a tougher line. Then you get this nervousness when Trump suggests and then goes forward with this sort of one-to-one meeting with no one else in the room. And I think people are worried about the way Trump negotiates and his deals. But bear in mind, there's a lot of pressure on Trump now, particularly from countries like Germany, Poland, the UK, France, not to make, you know, stupid concessions in the short term. And I think that one of the problems here is that Trump is more about optics than he is about content. And for Putin to have a one-to-one with Trump is a big issue for him. It's a big plus. Bear in mind, he hasn't been in the United States since 2015. And because he's the subject of an IOJ international arrest warrant, his possibilities for travel are very limited indeed. He can come to the States because the States doesn't recognize the IOJ's authority. But, you know, this man has a very difficult and tricky position internationally. He's very circumscribed.
Richard, I want to ask a question on something that Trump hinted at yesterday. He said that he does very quickly want to set up a second meeting, and he might bring along the Europeans to that meeting. Who from Europe would be involved in a third meeting?
Well, I think it's the four countries I've mentioned are the most likely. Poland, France, Germany, and the UK. I mean, they're the primary players. They are the nation states that have the military capability to support Ukraine seriously. So if you're looking at a broader conference, in my view, it is only those four players, possibly Meloni from Italy as well, because of her relationship with Trump and her ability to get on with him. And the Italians have played a significant role in maintaining the dialogue with Trump on these tricky issues.
Some people are thinking about this as a Yalta moment. Could this be a Yalta moment?
No, I think that's an exaggeration. We're nowhere near that, in my opinion. It may be a beginning of some sort of strategic change and rearrangement, but I don't think it's as fundamental, as basic as that. In a way, Trump raises expectations, and then sensibly, in my view, over the last few weeks, he's pushed them down quite significantly. And look, the expectation, I think, of those of us who follow this war closely is that there's no sign it won't continue for a good time yet. The Ukrainians are not in any place to make concessions themselves on territory. I mean, you could have a line of truce, like the division between North and South Korea, and then, prolonged negotiations after that as to whether this is going to be sort of stasis and a permanent line of truce. But there's no way that the Ukrainians de jure, I mean, according to international law, are going to surrender territory to Russia at the moment. The cost for them of the war has been high, and the cost for Putin also is very high at the moment. He's in a difficult place.
Sir Richard, a final question to you when it comes to another kind of aspect of the U.S.-Russia relationship that's on the table. In the lead up to this summit, Donald Trump and Dmitry Medvedev exchanged threats, basically, on social media when it came to repositioning nuclear submarines. This is something that really talks about their presence in the Pacific more than it does in terms of their involvement in Ukraine. Sir Richard, do we think this world is underpricing the risk of nuclear warfare, given the fact that an arms treaty hasn't actually been negotiated and some of the Cold War era agreements are no longer valid?
Well, yeah, the strategic arms limitation talks, it all looks like history now. Okay, there was a significant reduction, overall in the number of warheads. But, I mean, that exchange between Medvedev and Trump was, I think, largely optics. Look, these submarines which carry the nuclear deterrents are, permanently on station, permanently within range of their targets. And, Medvedev has said some pretty weird stuff, particularly about the UK and, the UK is an island and it would disappear in smoke. I mean, he has a record of making these outlandish statements. And I think it's sensible that Trump replies and reminds him of the enormous nuclear capability of the United States. But I mean, I don't see that the issue has escalated in terms of the threat of thermonuclear war. I think that we're still in a relatively reduced area. And I think that's the surprising issue about Ukraine, the fact that we have a major war on the European continent. And yet it's been contained and continues to be contained within the borders of a single country.
All right, Richard Dearlove, former head of MI6, thank you for joining us this morning. And stay with Bloomberg as we'll take you to that much-awaited summit between Presidents Trump and Putin. Tune into our special coverage live from Anchorage, Alaska.
What are we going to be doing next? We're going to be tracking shares of Orsted today after its credit rating has been downgraded by S&P. We'll also talk about some of the other stocks you want to be watching. Italy is closed today. I just bring that up after the Switzerland incident a few weeks ago. Italy closed for Assumption Day. We'll be back as we count you down. 15 minutes to go till the market open. This is Bloomberg. Minutes to go until the market open this Friday. It's Friday, we're mid-August. Don't expect volumes to be particularly high today. But there's a lot going on, and this summer has proved to be very positive if you are long equities. Does that trend continue? It looks like it may do into the open this morning. Futures are certainly positive. Let's get a sense of how the week's been. What were the highlights? What did he make of the PPI data yesterday? Mark Cudmore, Markets Live Executive Editor, joining us now. Mark, take on the week. And was PPI yesterday something of a game changer?
I think, first of all, this week has reaffirmed that probably the big theme for the next 6 months is inflation. It's not just about PPI. The details in the CPI were also not encouraging. It's just because we didn't get a really scary print that there's a bit of relief in market. But the reaction in front-end rates to CPI was more about the pressure that we got from Bessent and this administration on the Fed and what's happening there. But that, again, is inflationary. So the key takeaways are is both CPI in the details and the PPI show that tariffs inflation is coming through, and we're going to have more inflation coming through naturally from the trade policies that are happening from the US government. On the other hand, we're also getting pressure on the Fed to have easier monetary policy than would be justified by orthodox economic theory, which is also inflationary. So the big takeaway from this week is that inflation is coming to the US. You want to buy assets that will hedge against inflation, and you also should expect a steepening of the yield curve, with long-end bonds ultimately suffering over the coming 6 months or so, or maybe longer.
Talk to us about that margin pressure question, though. I mean, we just had a guest on that talked about the PPI data being a canary in the coal mine. For how long? When do we see the actual effect of that on corporate earnings?
Yeah, absolutely. What we're seeing now is companies are not passing on to consumers yet. And we've talked about this a lot the last month or so, that essentially because the stop-start nature of tariffs and the fact that there were so many tariffs that are imposed or later revoked, it does not make sense for companies to be premature in acting. They want to wait as long as possible. And because we've known this tariff story was coming for a long time, it was well flagged, people have been able to front load on their supply chains. They've bought time to delay reactions. That means that I was expecting that we'd see companies start to react by the end of third quarter, so we'd see it in those kind of earnings that come through in 3 months' time. In fact, when I wrote a piece on this a couple of weeks ago saying that's the rough timeline, most equity PMs wrote back to me and said, no, it's more likely in fourth quarter that we'll start seeing the pass-through to consumers. Ultimately, it will all be passed on to consumers because there's no competitive advantage to taking on the pain, given that tariffs are everywhere. So it'll all ultimately pass on to consumers, but we'll only really start seeing the severe impact of that in the fourth quarter in pricing, which means it'll be in the earnings results that we get in January.
Mark, I want to ask a question on your thoughts on this summit between Trump and Putin happening in Alaska today. How are markets playing this?
I think that overall expectations are very low. There's very little probability priced for a positive outcome. And therefore, I think there's a greater reaction if there is any positive outcome. I think a very positive outcome, like some peace deal framework announced, is an extremely unlikely tail risk. But I think there are various other headlines that don't result in oil higher, don't result in secondary sanctions, that are ultimately seen as being a risk on and a positive for markets.
Bloomberg Markets Live executive editor Mark Cudmore giving us his analysis this morning. We thank you so much. You get more from him and the team. MLIV Go is the function on your terminal. Let's go from the macro to the micro and get our stocks to watch with Chloe Melly. Chloe.
Good morning, Kriti. Let's start with defense today ahead of the much-anticipated meeting between Trump and Putin happening later today. This is obviously an industry we've been looking at for the whole week, and we'll see probably more activity in there today. So we should keep an eye on companies like Rheinmetall, BAE, Hensoldt. As you can see, all of those have been having a pretty good year, actually a really good year so far, but a lot really hinges upon the outcome of that meeting. Trump is tempering expectations a little bit. He said there's a 25% chance of the meeting not being successful. So we'll see where that goes, and keep that in mind for the rest of the day. Moving on to Orsted. Orsted was downgraded by S&P yesterday, and that's because Trump is stopping this offshore wind development, and that will have an impact on Orsted. It's already been having a tough year. It announced a share sale that sent the shares plunging already earlier this week, so we might see more weakness there. And interestingly, Danske analysts said that this was actually a very surprising downgrade. So let's keep an eye on that today. And then finally, we'll have a look at miners and steel makers, and that's after China released data that showed that the economy had really slowed down, and that includes production in its factories and in its mines. So we should keep an eye on companies like Antofagasta in that mining sector, and then ArcelorMittal in that steel-making sector.
Thanks to our equities reporter, Chloe Melly, for some stocks to watch at the European Open, which is just 7 minutes away. I want to bring up Orsted again, because what a move on the week. It's down, some 35%. I think it has to really bring this rights issue, this rights offering into question, whether it's going to be successful or not.
It's getting tough, isn't it?
It's not until October.
Yeah. And the share price keeps deteriorating, therefore it becomes more expensive.
The winds are tilted the wrong direction here.
The other sector we need to keep an eye on, though, is the luxury sector off the China read-through as well. So that might be one that actually moves through Kakarot more than we expected.
It's going to be really interesting to see what that read-across is into Europe this morning. Europe, industrially exposed, luxury exposed, The whole kind of consumer story feeding into the European narrative, but it's an industrial story as well, which we shouldn't forget as well. So I'm fascinated to see that. And it's the lending data that really kind of scares me about what's coming out of China at the moment. This is not a... It's not a positive picture that people aren't lending to invest at the moment. How does the government halt that narrative? Does the government want to halt that narrative? You could argue that bad news is good news from a China point of view, except equities have had a decent rally. Do you get this expectation you get more stimulus? So how do you play it this morning?
Yeah.
Do you look at this as a negative, or do you expect stimulus to come and therefore it's a positive?
Well, look, they've already done so much stimulus and it's not helped the Chinese consumer. But remember, it's not just luxury that's vulnerable, that kind of trade. The auto sector here,
yeah, that's what I mean.
very much leveraged to Chinese growth and to access to the Chinese market, depending on that. I mean, that's probably their one way that they want to get around U.S. tariffs, is double down on their interest and exposure in the Chinese market.
Which is interesting because futures aren't really blinking at all. I mean, almost 0.7% move. I'm looking at some of the industrial centers. The IBEX, for example, about 0.7%. The CAC from Iran is your outperformer in the futures picture this morning. FTSE 100 still up by 0.5%. We should mention the Italian market is closed, so we may see a little bit of a delayed reaction when it comes to Monday in terms of pricing today. We're going to dive into all of it. The opening trade is next. This is Bloomberg.
A few minutes to go until the opening trade this Friday morning, a day that is going to be dominated by geopolitics. It comes late in the day. It's dark in Alaska right now. It's light in Kyiv. Live pictures coming from the Ukrainian capital. A country very much on tenterhooks, waiting to see what the outcome is. Will the Ukrainian presidents, ultimately join these talks at some point? Is the second set of talks the most important one that we should be looking forward to? Would that be a win coming out of the summit that's going to take place today? Let's talk about quickly what is happening in terms of the story coming out of Thursday into Friday. This was the European session rallying into the close. We went out here, though, in the US session. The US session, we then see a little bit more of a rally. It was amazing considering the PPI data. Maybe not amazing, but it was interesting to see the PPI data still not producing a downdraft, a big downdraft in equities in the United States yesterday, despite the re-emergence maybe of inflation this week, according to Mark Cudmore. Val, what does that mean for futures?
Futures are looking pretty decently positive on this Friday morning. Maybe some optimism around the outcome we could possibly get in Anchorage, Alaska later today. Eurostoxx 50 futures up 0.6%. The broader index is up nearly 2% on the week. FTSE 100 up 0.5%. The CAC 40, a lot of interest here because we did have that weak China data, Kriti, overnight. It doesn't seem to be denting any luxury stock appeal.
Not at all, but we have seen Chinese data move that market before, and perhaps it's not being priced into futures. Maybe it will show up at the open. You mentioned the luxury story. The guy mentioned the defense story. Those are two key pieces of this European market that haven't been blinking just yet. We also want to give a little love to Orsted this morning. Of course, we know it's had a tumultuous week, as is Vestas, by the way. So the entire offshore wind sector very much in focus. Some of that coming from policy changes in Europe, some from the States, Guy.
Absolutely. Lots to keep an eye on this Friday morning. It is time for the open. Let's see what the numbers look like going into the weekend. This is the picture you find yourself with. Good morning, London. We are up by, let's call it half of 1% at the moment. Climbing. We're expecting that market to deliver a much more positive outcome. Remember, though, this is all being delivered with super light volume at the moment. We are mid-August. How many signals can you take away from the activity that we are seeing in markets at the moment, which has been largely in August very positive? Stocks 600 climbs another 0.1%. The FTSE's up 0.3%. The Spanish market's up 0.8% this morning. Remember, Italy is out. It's actually a holiday in large parts of Europe today. It is Assumption Day. The DAX is up by 0.6%. The CAC is up by 0.6%. I think the details are going to matter today. So let's see what they look like. Val, what do you got?
Look, when I look at the sectors, I have to keep refreshing my screen quite rapidly here, but all sectors appear to be in the green. At the bottom of the basket, though, is technology, only up by 0.1%. ASM and ASML not having a great open, but basic resources at the top of the basket. I know that's been a big focus for us because oil prices have been on the move around this Russia-Ukraine summit. Any possible breakthrough, Russia-U.S. summit, any possible breakthrough for Ukraine peace deal could be something that could boost cause some issues, I guess, for the oil sector with oil prices falling. But we're not seeing that kind of price action today. Autos are also at the top of the basket. I know we mentioned that weak Chinese data. It's not playing into European autos so far this morning.
Well, when you actually look at the breakdown here, it's a little bit of a reversal from yesterday. Some of the healthcare stocks are on the back foot. We should mention that Novo Nordisk is one of your underperformers. It is, however, ex-div today, so keep an eye on that one. Still moving this market, just given its weighting in the entire index. Your biggest index contributor to the upside is actually BBVA, which is interesting. Not seeing a ton of news flow there. We're still waiting for their tender period to launch in September when it comes to their acquisition there. Seeing a couple of healthcare names in the green as well, though. Roche, for example, is higher. Sanofi higher. AstraZeneca higher. Some of the oil names from yesterday that were a lot of them were ex-div have recovered in this market today. But, yeah, Guy, I'm seeing a lot of green on the screen.
It's interesting. AMAT actually was a disappointment yesterday, so I'm wondering whether that's what feeds through into some of the chip stocks out of Europe this morning. It's interesting that the Spanish stocks are on a tear once again, pushing higher. Are we kind of going to be able to continue with that trend? Spanish stocks have had an amazing run of late.
It's the siesta.
It's a fiesta or a siesta?
Both. Why not both?
Both at the same time. So does that continue? But the Spanish banks today definitely on the front foot. That's a narrative that it looks like it's going to be continuing as well. But, yeah, the AMAT story does seem to be acting as a bit of a drag today.
Yeah, and it's interesting that we were talking about drags in Europe, that weak Chinese data is seeming to not have any follow-through. I mean, Basic Resources, a lot of those are contingent on the iron ore price, but you see likes of Glencore and Antofagasta up over 2%. So it seems to be that the market is really not deterred from what we heard out of China overnight.
Is this the read, though, that it's stimulus is coming?
Perhaps.
And bad news is good news, and actually you take that as a positive? I don't know. Maybe you could. There's two ways of reading the Chinese story today. It's the data continues to get gloomier and gloomier. Is that a signal that the Chinese need to do more, and that should be taken as a positive? I don't know whether that's the right read. The Chinese have been very reticent thus far in terms of the authorities to deliver that stimulus in the size that's going to have an effect. So it's hard to really read what is going to happen here. But it's interesting that we're not getting a negative story coming through into Europe this morning.
Equity markets still think it's all okay.
I mean, we'll see if that's how we start Monday's session off. But I will say, on the luxury front, though, when you look at actually the CAC and the individual stocks there, they're not rallying to the same extent that some of their others are. I'm looking at Kering, for example, which is quite literally flat on the day. So I wonder if there is maybe some caution when it comes to luxury names. But then you look at the miners, you look at the EV or car stocks as well, and you're not seeing that same thing.
Pandora a luxury name?
I don't know. Would you buy it for your wife?
Let's not go down that rabbit hole. Down nearly 10%. Q2 earnings disappointing. That stock under significant pressure. So you've got ex-div for Novo out of the Danish market and Pandora being hit quite hard this morning. So two negatives may be coming through there.
All right, let's broaden out this discussion. And joining us now to do that is Patrick Armstrong, Plurimi Wealth CIO. Thanks for joining us on this August Friday. We did have a lot of data out of the U.S. this week, some of it good, some of it arguably bad. What was your big takeaway? Because the fixed income market seemed to have gone in a round trip.
I think the biggest mispriced asset in financial markets is inflation over the next decade. Markets just far too complacent on where inflation is going to be. You've got populist policies all across liberal democracies, printing new money to pay off the old debt's the end game. Austerity is not being considered. Tax cuts are being put in place rather than increasing taxes. So you're not getting real, sensible, long-term solutions for debt, and you're getting short-term fixes promising massive growth, and we'll grow our way into the debt rather than policies that address the debt. So I think inflation is going to be a long-term story, and it's priced that the Fed's going to have an immaculate decade at 2.3%.
It's very interesting. So you think inflation has upside based on all the fiscal spending, not necessarily tariffs. Is that correct?
Well, tariffs are part of it. Populism and nationalism go hand in hand. Tariffs are inflationary, nationalism is inflationary, and populism is inflationary. And those are driving forces in politics. And the market's got its hands over its ears. It's thinking about the Fed that's going to cut rates. And that's inflationary as well. So short term, I'm not really worried about inflation spiking with tariffs. I think inflation grinds higher with tariffs. But over the next decade, everything, all the forces are going to create an inflationary environment. And that's the actual political endgame. It's trying to be engineered, creating nominal growth to grow your way into the debt rather than real growth, which is much harder to achieve.
All about nominal GDP, not real GDP, right, Kriti?
I will not confirm or deny. This was a large conversation ahead of the show. But when you're talking about individual stock picks, though, at the end of the day, they're given kind of these government stakes that are being discussed, for example, or this populism. Is that how you pick stocks for the next 3.5 years?
I'm short intel right now, actually. So I find it a bit frustrating, a lot of these policies, because it's not capitalism. It's putting 20%, it's not a tariff, but a fee on NVIDIA and AMD on chips they're selling into China. It's things like that. It's a stealth tax. It's not even stealth because it's open, but it's a different kind of tax, and it's anti-capitalism. And taking a stake in Intel, you take stakes in companies when they're in financial distress and they're of national security concerns. But Intel's got $50 billion revenue. They don't need a stake from the government to see them through.
So the Trump administration will argue it is a national security concern, given the manufacturing sector. So what would make you change your mind on that take?
Well, it's too new right now to think about. I don't know if it is going to happen, and I think the jump is probably overdone. But it is something to think about that I hadn't thought about, because I do agree it's nationally important. I just don't agree that Intel's in distress. It's a low growth, low profitability, not great returns on capital employed, but it's not at risk of failure. I'm short it.
Oh, sorry, you're short it?
Yeah, unfortunately.
All right.
It had the big jump, and I was really happy with my short. But, yeah, these are the kind of things I didn't even think about, that the administration would be taking a stake.
Build me... Are equities a good inflation hedge?
They're a reasonable inflation hedge over the long term, but they come with a J-curve effect. Unexpected inflation like we saw in 2022, you get higher long-term interest rates, maybe even higher short-term interest rates. That puts multiples down. But in the long term, they are a nominal growth asset as well. So they're a reasonable inflation hedge over the medium to long term.
Are they a good inflation hedge at these levels?
Well, I've just reduced our overweight equities yesterday. We've gone back to neutral, so it's not a stance that I'm negative on equities. We do think we're in an environment where the Fed is going to be cutting monetary stimulus in an environment where the economy is not falling into a recession is good for equities. But today, it's a historic day, Friday the 15th. The MSCI World's trading at 2.4 times price to sales. It's never happened in history before, and that's where we're at today. So the multiples are a risk when you're thinking inflation hedge because the multiple contraction comes with inflation.
You mentioned you just reduced your overweight on equities. What was the main kicker for that? Was it just valuations, or are you less convinced on the AI trade? We know that's been a big juice for the U.S.
I'm not less convinced on it, but the multiples reflect it. So NVIDIA is the biggest weight in my global equity portfolio, but I don't love it right now at the multiples it's trading at. There's a lot priced in. If Intel's price doesn't change over the next 3 years, and all the earnings estimates are delivered up until 2028, NVIDIA will be trading at 28 times forecast earnings in 2028. That's if every estimate is met. So, and that's assuming the stock price doesn't change. So there's a lot of good news priced into it right now. So I've got a 5% weight in my strategy. It means I'm underweight versus the MSCI World, but I'm not worried about the hyperscaler spending. I'm just worried about the multiples that things have gotten a bit too frothy.
So in some ways, you're arguing that inflation is going to be juiced from all this fiscal spending. But you have to compare that with what's going on at the Fed, with all this political pressure, the likely dovish shift from a new Fed chair happening next May. What is the likely outcome of the combination of those two things in your mind, hot inflation and a dovish Fed?
That's great news for equities. I think you get a Fed policy that's far too low for the realities of the economy and the realities of inflation. It's terrible for long-term bond yields. And eventually equities will suffer from the higher long-term bond yields, but you'll get a real jump up from monetary policy that's probably
too loose. What does a real jump up look like?
It's hard to say. It's going to be a momentum-fueled thing where
I'm hearing a lot of people talking about parties at the moment. Maybe it's just August. If the party finishes at 2 a.m.
I'm doing the Irish goodbye right now. I'm leaving without saying goodbye. I've gone back to neutral, and if we have another leg up, I'm going to move underweight because things aren't priced for perfection, but it's almost perfection, and there's a lot of bumps in the road.
What's the downside?
The downside is you get to a normal multiple. You fall into a normal multiple.
So you put the market on 18. I think that's the average for the last.
Yeah, right now the MSCI World's at 21 times. The average maybe 15 to 17 times. And if you do get into recession with high inflation, a stagflationary environment, you've got to have a discount to a normal multiple. So in bad scenarios, there's 40% downsides. In my pretty benign case, in an economy that's growing but not falling into recession, you probably see a 10% multiple correction without that much earnings growth.
Love an Irish goodbye.
Oh, my gosh. A potential 40% downside, though. That is quite the call. In a worst-case scenario.
That's the
extreme, sure, but still, even the fact that that's in one of the scenarios. We should talk about the main event for today, especially when it comes to the defense story. We know that is a big chunk of your portfolio as well. We have a summit in Alaska between the United States and Russia. Is this a good thing or a bad thing for defense, but then also the European market broadly? How do you think about it?
Yeah, anything where Trump's involved, it's hard to have a high conviction because I think he reacts to things, and even if he has a game plan going in, it may not play out the way he expects it to because he's emotional, he's tactical, he tries to read situations. I do see scenarios where you're going to have another ramp up in European defense spending coming out of this summit. If things go wrong, U.S. may step away from supporting Ukraine with military, but I do think Europe is committed to increased spending to fill that vacuum, and European defense stocks have structural growth ahead of them.
And if things go right, what's a positive outcome? Does that include an unwind in defense?
I don't think you'll have a possibility of convincing Europe it went right. I think Putin and Trump may think they've got a deal, and then the details, I think that'll be hashed out with Europe, and you'll realize Putin's not conceded anything. That's just the way he's operated for decades and decades. So I'd be shocked if that changes.
So no defense unwind?
I don't think so, no.
I'm not going to let you sneak off without saying thank you. Thank you for coming to the party. Nice to see you.
He's leaving without saying anything.
Yeah, I know, but at least he's saying goodbye. Patrick Armstrong, Plurimi Wealth, CIO, thank you very much indeed. Quick look at the core six this morning. Slight change to the core six this morning. We've included Rheinmetall on that list. I might leave it there. Ferrari, maybe that time has passed. Italian markets are closed today. That was the initial impetus, but maybe actually this will be a permanent shift. LVMH is, interestingly enough, unchanged this morning. Novo is ex-dividend. I just need to make sure that's the right calculation on that. But Schneider's bouncing back a little bit. Nestlé's up 0.4%. There's some interesting stock stories out there. You've got Pandora getting hit pretty hard this morning. Orsted still in the news. Plenty of action for Chloe Melee.
Good morning. Let's start with the chip-making sector this morning. So we have a little bit of a mixed picture. We've got some read across from Applied Material, which is the largest producer of chip-making gear in America, and they provided a quite disappointing sales and profit forecast. So we can see a bit of that weakness feeding through into ASML and BE Semiconductor. However, Infineon and STMicro are holding up pretty well, but we don't see any major moves today in that sector, however. Moving on to miners. Miners are actually having a pretty good day today, and that is despite the fact that Chinese economic data was quite disappointing and there was a quite weak production in factories and mines. For Glencore, part of that boost might also be because its price target was raised at City this morning. So we see quite a lot of green across that mining sector this morning. Moving on to Pandora. Pandora is getting hit quite hard today after its revenue missed estimates. It said that the tariff impact was still a little bit unclear. It didn't really know what mitigating actions could be taken for that, and therefore that uncertainty is feeding through into shares down now 12.3%. And then finally, still staying in that consumer segment, the e-commerce retailer Boost also provided quite disappointing results this morning. The margin came in below estimates in noted soft consumer demand, and therefore shares are getting hit as well. We are down 5.3% at the moment.
All right, Chloe Melee from our equities team walking us through some of those early movers. We thank you so much. Coming up, we're going to keep a closer eye, I should say, and a deep dive into some of the other sectors. Oil traders, of course, watching for any indication if sanctions will be eased or tightened when it comes to Russia after the crucial meeting in Alaska between the leaders of the United States and Russia. Stick with us. This is Bloomberg.
Happy Friday, Friday the 15th. Welcome back. You're watching the opening trade. We are, let's call it 18 minutes into the equity market session. Broadly, we are higher. Some markets are closed today. Italy is out for the day or for Assumption Day. Athens, other markets around Europe also closed. In terms of what is moving, I think there's some interesting trades out there that are worth paying attention to. One of those is what is happening within the defense space this morning. Let's take a look at what is happening with the big names that we watch so carefully. And as you can see, there is some weakness. This ahead, of course, of the summit that's going to take place in Alaska a little bit later on. Donald Trump meeting with Vladimir Putin. They're going to be talking about Ukraine. They're going to be talking about other things, apparently, as well. But Ukraine is where the world's attention is going to be firmly focused. What is the relationship between this summit and the defence stocks that you see on the screen in front of you? Let's try and answer that question. Jerry Doyle, Bloomberg's Global Defence Editor, joining us around the table. Good morning.
Good morning.
So, in terms of the various outcomes that we are talking about, the permutations that we're watching, how do they relate back into European defence spending, European defence stocks?
Well, I don't know that there's a completely clear picture on that. I think a lot of the spending that we're seeing in the European defense industry right now is already baked in. There's 2 sixth-generation fighter programs that are well underway. Yep. I don't think those are going to disappear. In theory, yep. I don't think those are going to go away. Other things like building up production capacity for artillery ammunition, armored vehicles, small arms, drone production, I think a lot of those areas are places where the governments are going to continue to spend money because they see them as strategically important, regardless of what happens in Ukraine. Of course, if the fighting continues in Ukraine and the Europeans continue to supply Ukraine with ammunition and other war material, you can expect more spending, and those companies are going to benefit.
Jerry, can you talk to us about maybe Russia's defense capabilities here? I guess there's a lot that have been said about a weakening Russian economy and the fact that they can't necessarily afford for this war to extend on much longer. Is that the feeling you get from the defense sector?
Well, as Bloomberg has reported in recent days, the Russian economy is starting to show some signs of strain. One of the things that happened when Russia moved onto a war footing was the government mandated loans of a very low interest rate, sort of a government-decided interest rate that was disconnected from the key interest rate that the central bank set. And as inflation risks have risen in Russia, the key interest rate has continued to rise. So now all these banks that have loaned to the defense sector to build more armored vehicles, to build more artillery, more drones, more planes, they're stuck with loans that are just not going to perform. And we already saw VTB, one of Russia's main banks, the lending collapsed 49% in the last year. So those economic strains are going to be difficult to paper over and certainly sustain if the war effort continues like this.
Jerry, this is coming in the broader picture of maybe some skepticism when it comes to whether the European money that's been allocated to defense actually manifests into ultimate defense spending. You've seen Rheinmetall as a great example of that in terms of some of their contracts maybe not coming to fruition as they'd like. Regardless of what happens in the summit, which I know is a very hard thing to pull out, what is the risk that the money promised to the defense sector doesn't show up?
In the near term, I would say the risk is fairly low. With Rheinmetall, for instance, they are expecting those big orders, which are in the German defense budget, to come to fruition in the second half of the year. Now, the issue for them is the defense budget, or the budget has not, the federal budget has not been passed yet because the parliament is on vacation. When that happens in September, October, then that money that they expect will start flowing in. Over the longer term, it's really harder to say.
How much capacity does Europe have right now to deliver to Ukraine what it needs to carry on the war? If the United States was to walk away and Europe were to have to fund it, where would that place us? And would we find ourselves in a position in Europe where we have to basically buy stuff from the United States to keep this conflict going?
I would say it would probably be a little of both. Europe is quickly building capacity, again, for things that are easier to produce, like artillery shells. I think that would be a fairly easy way for Europe to continue to supply Ukraine. Other areas, such as armored vehicles, tanks even, would also be areas where they could continue to contribute. For higher-end systems like air defense, that might be something where they would need to continue to buy from the U.S. and transfer it to Ukraine.
All right. Jerry Doyle, our global defense editor, walking us through some of those dynamics. We thank you so much. I want to turn to another area of the market in focus ahead of the U.S.-Russia summit, and that is oil. Indian Prime Minister Narendra Modi spoke earlier about the country's oil dependency after Donald Trump imposed secondary tariffs due to India's purchase of Russian energy.
हम सब जानते हैं कि हम एनर्जी के लिए
We are dependent on a number of countries for our energy supplies. Be that petrol, diesel, or gas, billions are spent on imports. We need to get the country out of this crisis and self-reliant for its energy.
And, of course, oil traders watching for any indications that sanctions will be eased or tightened on Russia after the crucial Trump-Putin meeting. For more on the consequences, Bloomberg's Anthony DiPaolo joins us this morning. Anthony, talk to us about that ripple effect. I mean, Donald Trump has been very clear that if we get a negative outcome from this summit, sanctions may be put on more quickly than expected. Yet, one that was threatened earlier, the markets didn't react. How are traders thinking about this?
Yeah, good morning, Kriti. Well, I mean, you are seeing in the market that it doesn't look like traders are really concerned about a reduction in supply. So we're not seeing a very bullish move in the market right now. We've come down in terms of Brent prices over the last couple of weeks, and we're kind of holding that level around the 66, 67 handle today. So it doesn't look like traders are super concerned about a decrease in supply, so additional sanctions that would take more Russian supply off the market. We just heard those comments from the Indian Prime Minister because they are having issues there already in India because Trump has applied those secondary tariffs on India to punish them basically for buying that Russian crude. So they're being punished for buying that Russian crude while there are still really no direct sanctions from the Trump administration on purchases of that crude. We do have that G7 price cap in place. India has admitted that they've bought some cargoes above the price cap. They've been able to buy some below, and that's been a real price saver for them. So they're very price sensitive in terms of India. So that's why they've gone and really doubled down on these Russian imports over the last couple of years. So that's an issue that we're already seeing in the market. We're already seeing India scrambling for some barrels, buying from the Middle East, buying from the United States, other countries in the Americas. But we'll see those barrels shift around as they have done over the course of this conflict. So we're seeing that shift right now, but we're not seeing a major sign from the market that people are concerned that there are going to be fewer barrels on the market come Monday when markets reopen, Kriti.
Anthony, given the catalyst of this Russia-Ukraine meeting on Friday, do you think if we do get a breakthrough, we could see Brent crude returning to the year-to-date lows, which is around $58 a barrel? Is that a realistic expectation?
Yeah, I mean, for sure, a breakthrough would be bearish for crude, and the impulses already are a little bit bearish right now. As I said, we're not seeing that idea that there's going to be a lot of barrels taken out of the market, and even as Trump kind of hedges his bets and seems to say that there's not a great chance of a ceasefire in this meeting, we're seeing Putin making lots of other moves going in and wanting to talk about other things like nuclear treaties, like business ties. And we know that Trump likes to make a deal. He's very concerned about Russia's nuclear capabilities, and so that's one of the factors that's been influencing his relations with Putin, with Russia. So we know that Trump likes to talk about those things, and Putin is going to go into that meeting trying to give Trump some of those things that he wants to talk about. That also makes Russia appear in a better light as well as a global economic and military power to come up with a deal where they can kind of push that Ukraine issue aside. So not looking like we're going to get a deal on that, but also not looking like we're going to get additional sanctions on the oil.
Anthony DePaola.
Welcome back to the opening trade. About 30 minutes into today's session, green on the screen across the board. And I think this is really interesting because we opened at higher levels than this and started to pare back some of that momentum. I want to bring a special attention to the CAC 40 here because that is where outperformance is, despite the fact that we got some pretty poor Chinese data. Keep one eye on the DAX as well, because underneath the hood here, you are seeing a defense unwind. On the surface, not showing up at the top guy.
Okay, let's talk about some 52-week highs. There's a few in the market today. Interestingly enough, some coming out of the mining sector. Antofagasta up by 3.2% today. The mining sector, you would have thought would be affected by what is happening with China. Remember, this is a big copper producer. BMW in the car sector also, you could argue, could be affected. Big exposure into China, not big affected this morning. That stock is higher. Raiffeisen also tracking higher. There's a bunch of banks out there that are at 52-week highs today. Look at some of the Spanish banks, BBVA, certainly tracking higher. You've got names in the banking sector that continue to drive European equities. Just one example of that. But it's interesting to see that European equities very much on the front foot as we come in towards the end of the week, Val.
Well, here's what else is on our radar this morning. China's economy slowed across the board in July, with factory activity and retail sales disappointing. The latest snapshot suggesting Donald Trump's trade war is beginning to weigh on the world's second largest economy. And Intel shares jumped post-market after a Bloomberg scoop that the Trump administration is discussing buying a stake in the beleaguered chipmaker. We're told the administration hopes a deal would shore up Intel's planned factory hub in Ohio. The size of the potential stake is very yet unclear. Russian President Vladimir Putin is seeking to strengthen his rapport with Donald Trump ahead of their summit in Alaska. The U.S. president, meanwhile, is downplaying today's talks, saying that the follow-up involving Ukraine's leader will be more important. Kriti.
I mean, it's fascinating here that this is the biggest risk event that we are seeing. It shows up at about 8 p.m. London time with the joint presser expected to follow. But, Guy, it's the positioning going into this event that maybe is more interesting.
Absolutely. But I just think it's a wildcard event. Like, how do you position for this in a market that is very bad already at predicting geopolitical events? This is just an event that is even more difficult to predict. You've got Putin and Trump in a room together, nobody else. The outcome of this is very, very hard to read. Is this a risk event that you can, from a market point of view, do anything with?
Or perhaps, you know, an entertainment event with the likes of a joint press conference between the two leaders. We know that Trump likes to do what he calls the weave. Can't imagine doing that in front of Putin, but let's see.
There's been some quite interesting Oval Office experiences for global leaders. I would find it staggering to believe that such an event could happen with Vladimir Putin standing next to him.
I think it's safe to say that we'll all have our popcorn ready for that press conference if it comes forward. Our next guest, of course, has a piece out this morning on that summit titled "Trump Has the Means to Deliver an Alaska Surprise." Bloomer Opinion's Mark Champion writing that while he is skeptical that Donald Trump is ready to impose his threats of, quote, very severe consequences for Russia, it's worth remembering that he can. And if he does, he writes, he will be the first to admit in underestimating him. Mark joins us now to talk to us a little about your column. Walk us through that. What tools are at Donald Trump's disposal here?
Yeah, I mean, this has been interesting, you know, so even before he came to office, there was actually, if we remember now, there was a lot of hope in Ukraine, for example, that this would actually be a U.S. president who would be potentially stronger than his predecessor, Biden, in supporting Ukraine and be tougher. So there was that hope, and, you know, they could walk through exactly, you know, what the U.S. could do, what they needed in order to make it difficult for Putin. It ranges right from the kinds of secondary sanctions that, you know, Trump is talking about now, has been for several months, but has delayed, and then to, you know, what they can provide militarily. The U.S. has a lot of scope. It is actually the only country that can really you know, put that kind of pressure on Putin and make it just not worth his while to continue, simply because he would know that he's not going to succeed. But that would require an enormous about-face in what we've seen of Trump's approach to the war, his adoption of Russian lines on, you know, who's at fault and, you know, who's preventing peace. The way that, you know, you mentioned these, you know, encounters in the White House. We all remember, you know, Putin's real dressing down of Volodymyr Zelensky in the White House. So, I mean, as I say, I'm just deeply skeptical that we're going to see anything like that. We should remember, too, these summits normally, you know, these guys haven't met each other for quite a number of years. Putin hasn't been to the U.S. on this kind of a formal visit since 2007. You know, this is already a win for him in the sense that it's, you know, he's out of isolation, you know, quite prominently. But, you know, normally this kind of event, it is preceded by months of teams of Sherpas, all kinds of meetings, pre-meetings, and by the time you get to the summit, you know, most of it is already pre-written. This is the opposite. This happened, you know, was set a week ago. You know, Steve Witkoff went to Moscow, may have misunderstood what was said in a room, comes back, Trump starts talking about, we're going to, you know, get ready to sign a deal, we're going to do territorial swaps. Then suddenly the rhetoric changes. So, you know, it's, as you say, I mean, it's a real crapshoot to understand exactly what's going to come out of this.
What would a second summit look like? And would a second summit be more difficult for Vladimir Putin, in as much as he in some ways can control the narrative with Trump in the room, but you put, I don't know, who could come from Europe, the French, the Brits, the Commission, put them in a room as well, put Zelensky in a room. Yeah. Is this Vladimir Putin's best opportunity? If there's a second summit, does it become more difficult?
It definitely becomes more difficult. So even you know, optics is the wrong word, but, you know, even the sort of the physics of the meeting, in his mind, and he won't be wrong, you know, it then becomes him against a group of people who are in opposition to what he's doing. So, you know, the dynamic immediately changes. Secondly, once you have the Ukrainians at the table, you actually have to start talking, negotiating. You have to, the great thing for Putin about going to Alaska is he can talk to Trump. He doesn't even, he doesn't even have to talk about Ukraine if he doesn't want to. He's already, if you see what he's been saying ahead of the meeting, he says, well, there's great economic stuff, between the U.S. and Russia that we can talk. We can talk arms treaties. We can do all this sort of stuff. We're a long way from Ukraine and Europe and so on. This is just me and you, right? So that suits him very well. Dividing the world between great powers and so on. But when he gets in a room with the Europeans, it then gets very nitty-gritty, and he actually has to do things which at the moment he seriously does not want to do. He sees no reason to negotiate a ceasefire. He's winning on the battlefield. The Americans are weak on Ukraine at this point. So, for him, there's no purpose.
All right, Mark Champion from Bloomberg Opinion, we thank you so much walking us through, of course, the crucial geopolitics as we lead up to the summit. We are less than 12 hours away from this historic meeting between Donald Trump and Vladimir Putin. Coming up on the program, we're going to tackle this from a very different perspective. Tristram Leach, Apollo's head of investments for Credit Europe, about the continent's private credit moment, but also how they're thinking about the defense narrative and the AI narrative. Looking forward to that conversation next. This is Bloomberg.
Welcome back. 41 minutes into the equity market session, and this is the picture you find yourselves with. Actually, equities on the front foot. Volume is epically light. You have a bunch of markets that are out today. It is the Assumption Day holiday. Markets like Italy are closed for the day as a result. In terms of the breakdown, basic resources leading the charge this morning. You've got names like Antofagasta definitely on the front foot. Chemicals and cars are also doing well. Recent underperformers. It's interesting that technology is under pressure, as is luxury to a certain extent down today. Names like Pandora are under pressure. Technology fairly flat today. Disappointing numbers out of AMAT yesterday, maybe dragging on those figures.
Looking forward to seeing how this price action shakes out through the rest of the day. I want to take a moment and maybe approach some of these thematic issues from a completely different perspective, that of the private markets, specifically through the lens of Apollo. They're managing about $840 billion, with about 20 to 25% of that exposure right here in Europe. We've got the perfect guest to talk about it. Tristram Leach, head of investments for credit over at Apollo for Europe, joining us around the table on this Friday morning. Thank you so much for your time.
Pleasure.
Welcome to the show. We've been having this big thematic conversation about reallocation of American funds to Europe. This idea that Europe is the next kind of leg of growth, a lot of which shows up in the defense sector. Given the geopolitical concerns of the world, how are you thinking about that ramp up?
Yeah. Look, Europe has been underspending on defense. I think that's been pretty clear since the wake-up call of 2022 and obviously subsequently as well. So Europe needs to spend a lot of money on defense as NATO, European countries move to hit NATO spending targets of anywhere between 2 and even up to 5% of GDP. Across defense, as well as other areas of investment, infrastructure and energy, there's an enormous amount of spending that needs to happen in Europe. And we at Apollo, we've already done $50 billion of large-scale financings in Europe over the last couple of years. But with the kind of low-cost, long-dated capital we have, we're really excited to lean into that and the investment needs of the continent.
It's fascinating the way that private markets are taking on Europe right now, because on the one hand, firms like Apollo and credit investors themselves are kind of bridging that sovereign funding gap on the one hand. Yep. On the other hand, they're also speaking to democratizing the access to those kind of funds. Talk to us about how an average European investor can get access to some of the work you're doing in private credit.
Yeah, there are multiple routes by which we offer our product, both to institutions, some of which clearly are providing pensions to European citizens, and we also have product that's directly targeting the wealth market and semi-liquid product, etc., that wealth investors can access. So when we look at markets at the moment, you see a public market that's painfully tight, and you see really quite attractive premium to go into private markets. And obviously, we're foursquare behind the idea that private investors should have access to that more attractive risk reward.
Tristram, we're all talking about this summit happening in Alaska. Do you see the possibility that these funds in Europe are just deployed a bit slower than expected if we do get some sort of ceasefire? Is that a risk on your horizon? I see that you've penciled in, the fact that NATO's increase to defense expenditures to 5% of GDP is going to be around $7 trillion of spending by 2030. What's the risk around that number?
Well, first of all, I'd argue that regardless of the outcome of the summit in Alaska, the wake-up call that Europe has had in terms of defense is real. And that spending is going to happen. I guess your question is the cadence of that spending and how fast it happens. Maybe a little bit of the urgency comes out of the situation if it feels like there's a resolution happening to the Ukraine war. But I think the spending is going to happen. And remember, Europe has been underinvesting in a far broader range of areas than just defense. As I touched on earlier, it's infrastructure, it's digital infrastructure, it's AI. We think there's 18 trillion that needs to be spent across the continent in order for Europe to catch up in these areas. That's something that we're excited to provide solutions for.
Is there any risks around European economic growth that would possibly dent your optimism around European private markets?
I mean, Europe's been kind of a backwards from a growth perspective for most of the last 20 years. The fascinating thing here is just that so much of the European economy has been funded by banks. 75% of financing of US corporates is non-bank financing. In Europe, that number's in the teens. It's really small. So even if the growth is slower than people hope and we hope, by the way, we're excited about the German fiscal picture and the stimulus that can give to growth, but even if it's slower, the opportunity for private capital to provide these solutions and to enable European governments and companies to do this spending, that's real regardless.
Is there enough money to fund European defence and European AI?
Sure there is, yeah.
OK.
Yeah, look, both are big areas. I said the aggregate number is massive. That's why we need private capital, as well as public markets, as well as banks, all of those sources of capital. But here's the thing. This year in particular, we've seen a lot of interest from non-European investors to move capital to Europe.
Right.
People are saying, look, what's the opportunity in Europe? They've got a sense for the growth that's coming. They're thinking about rebalancing potentially out of the US.
So what's the motivation for that?
I think it's a palpable sense that Europe is changing. Europe's had its wake-up call. It knows it needs to catch up.
Right.
And there's real opportunity there. And let's be clear. People have been very, very overweight the US and very underweight Europe. So,
So this isn't that they love Europe. It's just that maybe they're overweight Europe. Over the United States, sorry.
Look, I think the sentiment towards Europe has changed dizzyingly fast this year, right?
Yes.
We came into the year incredibly negative, and now we have a world that's a lot more excited about Europe. So it's a positive thing for Europe, but it's also probably a reflection of positioning, having been very, very overweight the US historically.
Is the defence bet more logical in your mind? You're following something that has to happen. Is the AI bet more speculative at the moment?
I think it has to happen as well, right?
But are all the dollars going to, in 5 years' time, which one are we going to look back on and go, that was an easier investment to make? Is the AI story more speculative at the moment? Are all of these data centres going to deliver? Are the returns there going to be necessary? Are the amortization of these assets is it more difficult to make those calculations, or is there just a frenzy around it that means you just have to invest?
From an equity perspective, there's probably a little bit of a challenge as to whether, you're going to get the return you expect on every dollar you deploy.
Right.
From a credit perspective, there is clearly an enormous amount of investment that's going to need to happen. A lot of that is going to be in very scaled way with very large companies, exactly the kind of capital we want to deploy, investment-grade solutions to large companies with high-quality assets. So I think this credit opportunity is very, very compelling. Whether all the equity cases end up playing out, I share your view that it remains to be seen.
Let's go into the AI data center build-out question as well. From an equity perspective, one of the key concerns has been the backstop and the supply of energy. How does that show up in the way that you actually formulate some of these credit financing opportunities?
Well, I mean, the opportunities really are twofold. One is, as you said, the energy requirements of AI are massive. And that drives an enormous need for investment in energy, in grids, in energy security, etc. We just did the largest ever UK sterling-denominated private placement to EDF, 4.5 billion sterling. The use of proceeds there was to build out Hinkley Point. Again, that's a driver of energy security for the UK and energy availability. And in terms of AI, there's direct investment in data centers as well. We recently made an investment in Calvion, which provides heat thermal solutions for data centers, amongst other businesses. So there are these adjacent industries which can provide very, very compelling pockets of opportunity, both the energy sector and other adjacencies to AI.
Can I squeeze one final question in, which is a very macro-driven question? There's a lot of concern here that when you are investing in private credit, because it's growing so quickly and so fast, that should something go wrong, should financing conditions tighten, that it is a contained market and that any sort of pain or correction in the private credit market wouldn't be a systematic risk. Is that a fair read?
It's certainly how I position things. Look, the amount of leverage implicit in the system is not that high. A lot of private credit funds are either unlevered or modestly levered. And you know, when we think about a lot of the investments we make, our assets and liabilities match well. So you don't have the risk of kind of a bank run in private credit. So yes, there'll be a cycle, there'll be some dispersion, possibly between managers as well. But you know, I think we'd welcome that. We think that there's no asset liability mismatch in private credit, and the amount of leverage in the system is well contained.
Great to see you. Thanks for stopping by to see us. Really appreciate it.
Thank you very much. It's a pleasure.
Tristan Leach, Head of Investments for Credit Europe, over at Apollo. Let's stay in the tech space, actually, and talk a little bit about what is happening with Intel. The story overnight, a little bit mind-boggling in so many ways. The Trump administration apparently in talks now with Intel. Apparently the US government may potentially take a stake in the business. It was a scoop delivered by Bloomberg yesterday, picked up around the world. And Tom McKenzie joins us to talk about it. What do we know?
Look, it ties into your conversation you've just been having, which is that within the context of what the Trump administration is doing, they are looking to put capital into what they hope will be domestic champions. So what we know is, of course, the CEO, Lip Bhutan, went into a meeting with President Trump earlier this week after, of course, President Trump had called for his ouster as the CEO of Intel. He comes out of that meeting apparently with a Trump administration willing to take some form of stake in Intel. And the reason I put it in a broader framework is this is a government that, of course, is now extracting, will be extracting 15% from those sales and revenues from NVIDIA and AMD. They've also, of course, played that role in terms of US Steel, taking a golden share there in terms of that deal with its Japanese rival. And the Defense Department as well, taking a key stake, $400 million, in a producer of rare earth minerals. This is national security that is front and centre for the Trump administration. But there is a cost to this. They want that national security insurance, clearly, for these domestic champions. But they're also saying there's a price to pay. We want an equity stake or we want some of the revenue streams. We don't know the details in terms of this stake in Intel yet. But there's also the domestic politics, as well as the national security, as well as the geopolitics. There's domestic politics. One of the biggest fabs they're hoping to build out, would be the biggest in the world, they claim, Intel, is in Ohio. And that has been delayed because of cost structures and because they have failed, really, to lock in any major customers for their fabs.
Put us in perspective just how unusual this kind of investment agreement would be, because traditionally in the past, the U.S. government gets involved when they're bailing a company out, when someone's in financial distress. This is very much not that kind of picture.
Yeah, and it's a reminder of just how deeply and fundamentally the Republican Party has changed under President Trump as well. This is becoming less unusual. I gave those examples, of course, whether it's rare earth minerals, whether it's the steel space, whether it's NVIDIA and AMD. This is clearly part of a design and the playbook of this Trump administration. And from the sources we've been speaking to within the White House, our team in the US, this is probably not going to be the last of these deals. In fact, the Treasury Secretary himself, Scott Bessent, told our team this week that you should expect other sectors, other companies who want to have exposure to the Chinese market to possibly have and face similar structures as NVIDIA and AMD have. So again, it's about national security, about wanting these companies to set the standards when it comes to things like chips and semiconductors, whilst also trying to extract revenue. They're trying to have their cake and eat it, and whether or not that works is the key question.
The logic of it's national security, you don't sell to China.
Yeah.
So this can't be national security. It just, if we're going to sell to China, we want our cut.
Well, exactly. The Treasury Secretary is saying we want NVIDIA, for example, to be a standard setter, but we also want to be taking our cut at the same time. We think we can do both at the same time. We will see if that is doable.
You're on the hot seat for the Pulse in a few minutes' time, so don't go anywhere. Tom's going to stick around. Stay with us. There's a busy day coming up.
Busy day. A lot of data still to Friday to go. At 1:30 p.m., we do get a big print, U.S. retail sales. Remember, this is a direct feeder into U.S. GDP, so perhaps give us a good hint on where July is headed for the U.S. economy. We also have UMich consumer sentiment, and then the big one, the Trump-Putin meeting at 8 p.m. London time. It will begin.
Absolutely, which will set us up nicely for the weekend. There's plenty of things coming up this weekend. The Gracia Festival, Barcelona, is taking place. We've got an amazing horse race taking place in Siena. That is one to watch out for. The football starts as well. Bournemouth. I think Bournemouth are going to Liverpool. That's not necessarily the way I would like to start my season if I was Bournemouth, going to Liverpool. And the World Games continue as well. Tom, what's on the agenda?
I've been to the Palio in
Have
Siena.
you? Oh,
it's bonkers.
Yeah.
So the jockeys ride round this ancient square, and it's a small town, and you just turn a corner, and each district has their own champion, their own flag, emblazoned on their own jockey. When I was there, they had no helmets, no safety gear. They get thrown off into the city walls, and you're there as a spectator, standing within feet of these jockeys racing around this ancient square.
So
no saddles.
Yeah.
No stirrups. No.
Yeah.
Do they have reins? I can't remember if they had reins. Oh, there's no health and safety.
Come on, Val. Sienna.
No health and safety. The food's amazing as well around the whole thing. So there's amazing food that goes with this too. So it's not just that. Anyway, it's a spectacle twice a year. Anyway, we should also talk about the football as well. As I say, Bournemouth. Tough start, going to Liverpool.
We're speaking to Gary Neville shortly, and we're going to be asking him who he thinks is going to win the Premier League. Salford City, of course, he has a big stake there. So we're talking about Salford City, we're talking about whether or not, can Liverpool do it again, or do Arsenal finally have the title in their hands?
I'm sensing an Arsenal fan amongst us.
We're playing Manchester United, so that's a tough game.
Is it?
To start things off.
For who? I think Manchester United may be the other way around. Anyway, the weekend is coming up. We've got some great coverage. Bloomberg Weekend, the newsletter. You definitely want to pay attention to that. News, interviews, ideas, long-form stuff that you can relax and enjoy over the weekend. We'll see you Monday. There's going to be plenty happening between now and then. Enjoy the weekend. The Pulse is next. This is Bloomberg.